Hello, everybody. Welcome back to our podcast series dedicated to military personnel, their families, and VA employees, as well as DoD. My co-host is financial advisor Ron Friddle. This is Jeff Roediger. Ron, welcome back.
Thank you, Jeff. Thanks for having me back.
Okay, so today we wrapped up our introduction to this podcast series in the last episode talking about financial foundations, and we want to get into the process that you take your clients through. And so let's start with, what is your approach in helping people with their finances?
Okay, well, Jeff, I just want to mention that my practice is exploding in the way that I'm bringing my clients onto the platform that I use, because the platform really is something that helps them to organize themselves and really get themselves to another level of knowing their finances. I have a platform that's called the Living Balance Sheet. It's kind of a unique platform in how it does its organizational segregation. It helps them to find for themselves how they can be better insulated and protected from financial mishaps and problems that they come across. So I made a professional commitment to help these people take a stand and help them to challenge them in their traditional ways of thinking about money, and how they can also understand how to avoid purchasing and implementing products that could be dangerous to them financially. All these I can show them through this platform called the Living Balance Sheet. I think two of the guide words I use when I talk about this approach is balance and uncommon. A lot of people, I find, because they're involved in their work and their careers, they're operationally deployed if they're military, that they're not balanced financially, or they have holes in their financial affairs, or conversely, they have all of their eggs in one basket. So they seem to be, get askew over time, the way that they set themselves up, and come to find out that they're not balanced in their approach. So we focus on the balance. When I mean balance, I mean how they can have their financial statement or net worth or balance sheet, whatever you want to call it, construed so that it's balanced over time and over asset classes that they have. So, the other part about it, as I mentioned, it was uncommon thinking. Most people in the country that are wealthy actually think real uncommonly from what is, I would say, the internet approach or the common way of thinking. Most common thinkers they don't reach or achieve a real high degree of success, we found out historically. So what are we talking about when we say common thinking? Well, there's a lot of financial myths out there, right, that I think have become commonplace. I can just name off a few of these. You might hear out there that you only need to keep pace with inflation. And while that is true, inflation is just one of the factors that we need to consider, and we can find ourselves falling behind if we're just keeping pace with inflation. The tax bracket way of thinking that in retirement we will be in a lower tax bracket, and I would say that most retirees are trying to achieve somewhat of the same level of lifestyle in retirement that they had before they retired. So that is commonly meaning that they're going to stay either in a same tax bracket, or if taxes go up, be in a higher one. And actually, in some cases, it's better to be in a higher one, because that means your finances are doing well and you find yourself in that bracket. And another corollary to that would be that if the tax brackets change over time. So even though you may fall into a lower one, they may be expanding that bracket out so that you find that the tax difference is minimal, even though your income is less. Another common thing that people think about is, life insurance, and life insurance being just a cost in their lives, and not thinking that insurances are important in their what I call their the out years, and what insurance, what value does it have? The common way of thinking is that it just drops off, and since it's true in everybody else's lives, that therefore it's an assumed um, uh, inevitability that would happen, and when in fact that doesn't have to be the case. I call insurances in the out years as something that we repurpose and can use for living purposes. Disinvesting. It's true that as money moves through time during retirement, that a lot of times disinvesting is different than when you're compound averaging into your retirement. There can be devastation involved with the market. If the market does fluctuate down during the initial years of retirement, it can cause a lot of damage to you reaching your retirement goals. Rates of return versus savings. I find that most people are chasing rates of return and thinking that is their financial priority, when in fact I can show you that decisions around just trying to have more liquid approach to your investments and having more of savings is a much better priority to have than just the rate of return. Although that rate of return is important, it's not the most important factor, especially when you consider that most investments, although they run the gamut, they also take on risk during retirement too. So people think they have time to rebound if they get real risky, but the runway is shorter for you to be able to do that. Let's see, that's some of the common myths that are out there that I try to dispel, and this with this uncommon way of thinking. So we will talk about those myths more in detail, but I just want to get on to the next part of this, which is talking about how we do our planning here.
So how do you help your clients achieve their goals financially? I know that you have a fundamental disagreement with what you would call traditional financial planning, correct?
Yes.
So could you share with the audience, and I agree with the way that you approach somebody's economic situation. Can you help educate the audience on why your process is more efficient and different?
Sure. I think that most planners, when they talk about finances, they talk about this formula, your goal that you're trying to achieve, and many people have many goals, and that equates to a certain variables, being time, the amount of money you throw at something at a goal, and the rates of return that you achieve to get that goal. And although is a financial equation, it's wrought with a lot of guesswork, because all three of those variables, time, money, and rates of return, are not set in stone. In fact, they fluctuate. And I'll give you some examples here. The time that we have to invest can change as life events happen. So we maybe get hit and smack in the face with something that shortens the amount of time we can put towards that goal. We also find that we have competing um, goals out there. We have many goals, and that the money we have can change that we can put towards those goals because of, again, life events that could come up to shortchange the amount that we can put towards those goals. There's a lot of moving parts in, a person's life that, in competing uh, goals that we're trying to hit. So in situations that arise. So what happens is, because we fall short on these goals for many reasons. Discipline is one of them. Unforeseen events, as I mentioned before. What happens is that because we fall short, a lot of times we want to change up on that on the rate of return I was talking about previously. So we have to get in relation to that more risky in how we change to get to our goal now, because we're short of the goal. So we're going to change the interest rate to try to achieve that. And doing so then puts you into a more risky situation, especially for retirees. That's not the way you'd want to pursue goals that you have in retirement, is to get more risky, because again, we don't have the time to rebound in case the market again does not achieve, in a more risky situation, the goal that we want. The other thing to realize is that these goals that we're achieving are affected by what I call threats, things that are out there that can threaten our ability to get to that goal. And those, are things that, people are familiar with, inflation, taxes, savings rates, divorce, inaction, where people just get financially paralyzed. They don't know what to do. So the time value of money is a factor in their decision making, because they have shortened the time frame for that goal to happen. People's behavior on how they might human behavior or a money manager's behavior have all these have what I call are threats to you achieving goals. So we have to be able to prioritize those threats, as I brought up on the screen here, and we have to be able to, I guess, attack the biggest threat first. So it's good to be able to prioritize the threats. We can label these and number the threats that we have, and then try to go after the biggest threat first. And that's my approach. By doing so, eliminating threats, you then put, the police barrier around those things, and eliminated that as being, the biggest issue of you achieving your goal.
So this is how you help prioritize your client's finances?
Yes, that's the methodology I go through. It's prioritizing things on your balance sheet, right? This is the balance sheet that I'm talking about. It's, as old as the hills. It's, assets minus liabilities equals your net worth. What I've added to it through the living balance sheet into my practice is the domains of protection and cash flow. And now that you have all of your finances on one page, I call this as a wide angle view of your financial castle. So you now can see, and for one thing, you've become better organized by putting it on one page. You can see all of the interdependencies on these 19 different modules and how they affect each other. And now you can use what if scenarios to see how every one of these are affected by something you do in another module. So this is important because people have multiple advisors in their life that tell them to do one thing or another, And when you do so, you do that in a silo that you don't realize the effects that one decision can have on everything else. So
Right.
this balance sheet, it represents everything you've done up to this point in your life, and kind of brings to bear contextually how, because of every decision we make that has a monetary value to it, how it affects everything else. It kind of represents all the decisions you've made throughout your life.
Holistic planning. I like it.
Yeah, so this is holistic planning. That's what I engage in my clients with. Everybody has, the same kind of structure in that you put things into your financial balance sheet. It gets, I say churned around. The money flows through the balance sheet, and it comes out the other side through in the net worth. So it's very important on how you treat money and look at it. And an example would be, if you put money into an investment that has a high tax rate, maybe not while it's being growing, but maybe it's taxed on the way out. The way that it's taxed might have introduced in a holistic way more taxes into your life. So when I work with clients, I don't. One of our approaches um, is that we first of all work with them in complete confidentiality. Secondly, we try to not increase risk in your life. So we're not going to do anything that would change that. So how do you go about creating more value is by actually, in some cases, decreasing the risk. And you do that by eliminating some of the taxes. Instead of increasing risk, maybe eliminating taxes, looking at a holistic view of how you would do that. Okay, and then the third way is my approach is trying to find um, strategies, way of deploying things so that there's no additional out-of-pocket expenses to a client.
That's very unique. Most advisors are looking to take more out of somebody's pocket to solve a problem.
Correct. Yes.
That's
So each
great
of our clients
information.
get this personal planning sheet at no obligation. It helps them to aggregate their finances, to do what if scenarios for themselves, put certain assumptions in, and it helps us as we work together to work through their life and their goals much better than trying to do it from an approach of what do you need. It's what is facing them in their life externally and within their balance sheet, and working from there. So each day or each time we meet, there's new things that they're facing, so we can reevaluate as we go.
Great information. And I'd like to tell everybody that Ron will meet with you virtually and discuss your situation initially at no cost. So there's no cost to go through this consultation process. And if you'd like to get more information, this is unique, and Ron's been doing this a long time and understanding not only the military benefits but the federal benefits. Uh, he's a great resource, so you should take advantage of it. Well, thanks for your input today.
Oh yeah, thank you, Jeff. Thanks for having me again.
So if you would like to set up a consultation, we make it real easy. Go to fedchecklist.com. That's our landing page where you will find the 12 must-ask questions each of you need to be getting answers to before you retire. You can also book a request for a consultation with Ron and his team. You can also download a workbook and budget to prepare for your meeting. There's also some great questions as to what retirement means. You need to be thinking about that, not only just the finances, but also what are you retiring into. So it's a great report. You can download that on the site. And then if you have questions, you can put it in the comment section, or you can call us 888-545-8840. Again, that's 888-545-8840. So, all right. So this is episode 2. What are we going to be getting into in our next session, Ron?
Yeah, so my approach again is to talk about threats, and what I find out is when people order their threats, we usually get into talking about their protection domain,
Okay.
um, because you find out that a lot of those things that could happen if they're not properly protected have the most consequence to their financial balance sheet. So we'll be talking in this next session about the survivor's benefit plan. One of the first things you face as you retire and transition out is how you set yourself up. It's
Right.
almost like a dichotomy of ways you can look at this. And so I talk about that survivor's plan and how I think it's kind of scenario driven. So I'll get more into that in the next session.
And also for the civilians out there, their FEGLI, their Federal Employee Group Life Insurance, and what some alternatives are. There may be some, you talk about no additional out-of-pocket costs. We see a lot of times there's ways to increase benefits with no additional cost by reviewing that, or maybe even reducing their costs.
Correct.
So, okay. So you're going to want to join us for the next episode. Look for the upload and make sure you reach out to us. This is a very unique planning process. I believe in it. Ron, as you witnessed today, understands holistically how to look at everything, and I 9 times out of 10 he's going to find money that you're wasting somewhere. So, okay, this wraps up our session. Join us again and look for the next episode. Thank you very much.